Most buyers are watching interest rates, but they're missing the bigger risk. It's not just rates going up, it's what happens when borrowing power drops and prices are inflated and the wrong buyers are holding the most risk. And that's where things start to break. Right now, most people think the market is just cooling off. Rates go up, demand softens, price adjusts, simple. But if you look at the data and how buyers are behaving, it's not that clean. What we're seeing is a structural shift, and the people who are most exposed are the ones who entered the market recently with the least buffer. Let's break this down properly, because there are a few layers most people completely miss. First, borrowing power. This is the part almost no one explains clearly. When interest rates rise, it's not just repayments that go up. Your capacity drops, and it drops fast. There's a rule of thumb in lending: for every 0.5% in rates that drop, your borrowing power falls by roughly 5%. So if you're looking to borrow $1 million, 2 rate rises later, it's $950. Same buyer, same income, same deposit, just less firepower. Now here's what matters. Property prices don't move because of sentiment, they move because of capacity, what people can actually pay. So when borrowing capacity drops 10%, the market doesn't feel weaker, it is weaker because buyers physically have less money. Second, government incentives. This is where things get interesting because what sounds helpful often distorts the market. Take low deposit schemes. 5% deposits, even 2% in some cases. On paper, this looks like helping people get into the market. But here's what most people don't realize. You're not increasing supply, you're increasing competition. If 50 buyers suddenly have access to the same borrowing range, they all turn up to the same auctions and they push prices up. Not because the property is worth more, but because everyone has the capacity to borrow more. We see this clearly in the data. The lower price bracket, sub 1.5 in Sydney, lower in other cities, that's where prices have surged the most. Not because these properties suddenly became better, but because demand was artificially boosted. And here's the risk. Many of these buyers didn't enter the market at the right time. They were pulled in early with minimum deposits and inflated prices. Now layer in rising rates and falling borrowing capacity and you get pressure, real pressure. Third, the part that no one really talks about, unemployment, because this is the real trigger. Most borrowers can handle higher repayments. They cut spending, they adjust, they dip into savings. But what matters isn't the rate, it's income stability. And if someone loses their job, everything changes. That's when properties don't get sold by choice, they get sold out of necessity. Think about a buyer who bought recently. With a 5% deposit, an inflated price, with rising repayments, if prices soften even slightly, they're in negative equity. They owe more than the property's worth, and income stress, and now it's not a strategy decision, it's a forced sale. We're already starting to see early signs of this. Mortgagee sales are still rare, but they're no longer non-existent. And that shift matters because the market doesn't turn when headlines say it does, it turns when behavior changes. Now here's the move perspective, because this is where the data beats the guesswork, right? Most buyers look at interest rates, median prices, auction clearance rates, but that's surface level. What actually matters is borrowing capacity, trends, buyer composition, price segmentation, and risk concentration. For example, if you see strong growth in lower price brackets combined with high use of low deposit lending, that's not growth, that's leverage building. And leverage markets are fragile. They don't correct slowly. They shift quickly when conditions change. Another thing most people miss, not all parts of the market behave the same. Right now we see two completely different markets. On one side, mortgage holders, first-time buyers, highly leveraged households. On the other, older owners, no mortgage, high equity, strong cash position. When rates rise, one group gets squeezed, the other benefits. So when you hear the market is strong, you have to ask, which market? Because they're not the same. This is why relying on headlines is dangerous. You need to understand who is buying, how they're buying, and what risk they're carrying. Now, what should you actually do with this? First, stop thinking in terms of price alone. Focus on capacity. Where is borrowing power moving, up or down? Because that drives prices next. Second, understand the buyer pool. Are you buying in a full segment full of low deposits, government incentives, and highly competitive first-home buyers? That segment is more volatile, not less. And third, build margin into your decision. This is where most people go wrong. They buy at their limit instead of buying with a buffer. At Move, we'll look at what happens if rates rise. What happens if your borrowing capacity drops? Would this property still make sense to you? If the answer is no, it's not a good buy, no matter how good it feels in the moment. And finally, don't confuse access with readiness. Just because you can buy doesn't mean you should. The market doesn't reward urgency, it rewards positioning. So here's the key idea. Property isn't just about what things cost today. It's about how sustainable those prices are, given who's buying and how they're financing it. If you understand that, you stop reacting and you start making decisions with clarity. And that's where the real advantage is.